Welcome to No Fluff, Just Ideas. This is your host, Sophocles, and we're going to be discussing investment ideas from around the world. So buckle up and enjoy. This podcast is for educational purposes only. Full disclaimer at the end of the podcast. So, ladies and gentlemen, I have today my good friend, Samir Mohamed. I've known Samir for a decade now. He's been coming to my Cyprus event for at least 9 out of the 10 years. He's a private investor. He is actually dialing in now from Thailand. Over the last few years, he's become a specialist on metals. Did a podcast on G mining. Do check it out. I'll put a link in the description. And today, because of how well silver is doing, I reached out to Samir. And he said, yes, I am invested in a company called Abra Silver, and let's do a podcast on that. And I'm like, that's fantastic. So I'm really happy to see Samir here on the podcast, and I'll also be seeing him in person in March when we meet together for our second Asia event, March 24, 26. So if that interests any of our professional listeners, check that out at fatalphavalue.com/Asia. Welcome, Samir.
Thanks, Sophocles. And I'm looking forward to the conference in Vietnam.
So give us a summary. What's the pitch here on Abra Silver?
Maybe briefly on silver. So why would anybody bother with silver? And the reason for that is because silver typically lags gold in a precious metals bull market initially, but in the later stages of a bull market, it normally outperforms. And it looks to me like this phase of outperformance has started in April this year. Now, why is it interesting to look at silver miners? Two main reasons. One reason is silver miners are extremely rare. So if you find a company that has primary silver, that means more than half revenue from silver in the future. That means it's an extremely rare case compared to gold miners, and that increases, of course, the value in case of a takeover or just in general on the valuation. And the second reason is in the development stage of these assets, you have sometimes phases where they're structurally undervalued. And I think that's the case with Abra Silver. Brief description, the company is an explorer in Argentina. They have one asset in a province called Salta province, which is very mining friendly. They have been exploring this now since end of 2019, added significant resources, that means significant amounts of gold and silver that they found at the ground there over the last 5 years. And they are currently in the last technical study that will be published in the first half of next year. And then from a technical study perspective, they're actually ready to build a mine. So that means we're talking about maybe having a producing mine in late 2029. What is also interesting is that Argentina has had a lot of changes over the last 2 years in terms of investment attractiveness because the administration under Milei has introduced investment incentives that are very attractive, in terms of tax rates, in terms of abolishment of export duties and stuff like that. And the company has applied for these investment incentives just a few weeks ago, and they expect to get the approval sometimes in the first quarter next year. And the company is also in the final stages of basically getting the environmental permit. So they expect to have the environmental permit also the first quarter of next year, possibly in January. So basically, the stars for the company, I think, are really aligning over the next year to have the environmental permit to build a mine, to have the approval for the investment incentive, to have the technical study ready. And after they have done all this, it's basically just a matter of getting the financing for the mine organized and then building the mine and going into production. And this all in a silver bull market. So that's why I think it is currently probably the most attractive mining investment I have in the portfolio. In terms of margins, it's also interesting. I mean, the company has a production cost per ounce of roughly $13. So you can imagine with more than $60 an ounce currently, this gives them very significant margin. And it also helps to make the company safe, because even if the silver price drops significantly, they're still very profitable. Yeah, so that means I have no doubt that they will be able to get the financing to build the mine. Recently, when I looked at numbers, actually the payback period for the current capex estimate was like 7 months at silver prices that were below today's prices. Yeah, so for me, it's very clear it is an excellent asset. They will have no problem financing it to build a mine. And in addition, it's also growing. Yeah, so they continue doing exploration and they add significant amounts of silver and gold in the ground that they have found. And I mean, it's not just the mine, the value that the mine that is going to be built, but it's also that the reserves are growing all the time because they continue exploration. And that is pretty rare. Yeah, normally exploration companies do a lot of exploration for many years and then they decide, okay, they have enough gold or silver and then they build a mine. But it's pretty rare to have a company that is continuing exploration and doing it very successfully. So they add significant amounts of gold and silver every year, roughly 40 million ounces on average per year over the last 5 years. And this means the value is growing continuously, and then the mine could either extend mine life or have more production.
So this is basically from the study because they don't have any production now. They're
still in the studies.
So they're still in the studies, but as they're going through the studies and doing more work, they're discovering that the reserves are more and more.
Yes, because they still continue exploration. Yeah, so they still have drill rigs on the property, and they continuously publish results from these drill campaigns. Yeah, so every few weeks they have now a press release where they say, "Hey, look, we have 10 more holes, drill holes," where they give detailed results of the drill holes, how much gold, how much silver have they found, where is it located, etc. And then you can see, okay, the reserves are growing. Announced recently that they will do an update of the resource estimate in spring next year. So basically by the end of the feasibility study, they will have another resource update where you see, okay, how much more gold and silver is there available for them to mine. And they will then build the plan to do the mining and to build the mine on this latest resource update in probably spring next year.
Okay, so and you said the $13 production cost. Is that like the AISC?
Yeah, that's the all-in sustaining cost.
Okay, the all-in sustaining costs. Financing, how much money are they going to need?
The technical study that they published end of 2024, which is a so-called pre-feasibility study, they had a capex of $544 million planned, and we will get an update on the capex number when they do the feasibility study, when they publish that one. Yeah, so it may be a little bit higher, or it may also be a little bit lower because they have some optimization potential that they recognized, but it will be in that range of roughly 500-600 million, I would expect. Yeah.
So how are they going to raise that 544 million, like debt, equity combination?
Yeah. What I would expect is that they have a combination of debt and a streaming deal, I believe is possible. Yeah. So debt is clear. And I estimate that they can probably finance half of it with debt easily, given the high cash flow they have. So that leaves about $300 million that I would expect they do with something that is called a streaming deal. A streaming deal is basically a financial agreement between the company and the royalty and streaming company that says that the royalty company gets a certain percentage of gold or silver production per year, basically for the life of the mine. Yeah, that's how it works. And what I could imagine is that they do a streaming deal for the gold that they produce, because they produce a combination of silver and gold out of the mine, and then get the financing. The reason why those streaming deals are very attractive is because the value of a streaming financing is typically higher, or is almost always higher than if you would do an equity financing. Yeah, so you actually have less dilution if you do a combination of debt and streaming compared to a combination of debt and equity.
So you're not afraid of getting diluted, basically, your base plan.
Exactly. Yeah. So I don't think there will be much dilution in terms of equity dilution. And to give you an example, actually the company we discussed in the previous podcast, G Mining, they also did a streaming deal with Franco-Nevada at that time. So they financed more than half of the capex of the mine through this streaming deal.
Was that for the Oko West?
Yeah. No, that was for Tocantino for the first mine in Brazil.
Yeah. TZ. Okay. So again, we have that podcast. Go and take a look. And actually also did a short piece on Substack on that, which should bring you up to speed on mining. So we have the financing. We're going to get this production. You said $13 cost, $60 silver price. What about on gold? Because you said that we have gold and silver.
Yes.
Can you, it's like a little bit the breakdown of like, how many, how much is the expected production of silver and how much the expected production of gold?
Yeah, so it's a bit more than half of the value is silver. Yeah, so they said roughly 55% silver, 45% gold. And of course, it depends on the gold and silver price on a relative basis. Yeah, if silver outperforms gold like it has done the last few months, then the ratio will be tilted towards silver. And it also depends on how much more they find in the exploration. Yeah, if they find more gold-rich areas or more silver-rich areas, that can also then tilt the ratio. But it's a bit more than half silver. That's why it's a so-called primary silver mine. In terms of how much do they produce, the mine plan that they published end of 2024 had an annual production on average of 7.6 million ounces of silver and 76,000 ounces of gold. I would expect that the mine plan they publish next year probably has at least the same amount of production, maybe more, because they have found higher grade areas that they can mine first, and then obviously the amount of gold and silver that they produce increases. In addition, they might also, during the life of mine, increase throughput in a second stage. Yeah, so initially I expect that the size of the plant will not change, because this is related to the environmental permit they applied for. But after they have ramped up production, they can then apply for a capacity expansion of the processing plant. And this could then lead to them having, let's say, maybe 3 or 4 years after initial production, they could, or maybe even 2 years, they could significantly increase production. The CEO said in a recent interview they may actually double the size and the throughput of the plant over time.
So you said 76,000 ounces of gold. How much was silver?
7.6 million ounces. Yeah.
0.6 million ounces of silver.
Yes.
And then 76,000 of gold.
Yes.
Okay.
Yes.
And have they said what the AISC is of the gold?
You can't separate it. You can only, because it's in the same area. Yeah. So if you take a ton of ore, it contains both gold and silver. So the way they calculate it is they calculate something called the silver equivalent cost. Yeah. So they convert gold into silver ounces and then say, okay, how much is the cost per silver equivalent ounce? And this one is, I have it here, $12.67, $0.67.
How do you model this?
I basically just need to convert gold into silver ounces, yeah, with the ratio between the gold price and the silver price. And then I know, okay, how much is the silver equivalent cost that the company also publishes, yeah, and then I can calculate it. So basically, I convert the gold into silver, yeah, silver equivalents with the gold-silver ratio. And then I say, okay, how much, based on the published data of the company, how much is the cost? And then I know what is the operating cost per silver equivalent ounce.
Okay, so if I understand correctly, are you just saying like, okay, there's 76,000 ounces of 1,000 ounces of gold.
Yes.
So I multiply that by the ratio of
gold to silver.
Gold price to silver price.
Yes.
That ratio. I get a number, and then I treat that number versus the silver price and the silver cost.
Yes. I can give you an example. Let's take, let's take, to make it simple, $4,300 gold per ounce and 65 silver, which is pretty close to where both metals trade today.
Okay.
That gives you a gold to silver ratio of 66. Yeah, so 1 ounce of gold is worth 66 ounces of silver. And then I can basically say, fine, based on with the gold silver ratio, I can calculate how much is the production if I convert it all to silver. Yeah, and then I have the production number per year in silver equivalent ounces.
So then you do 76 times 66
I
to get
take
the
60.
equivalent.
Exactly. So basically, if I take the average production number, yeah, so I take these 76,000 ounces of gold multiplied by 66, and then I know how many ounces of silver it is, or how many ounces equivalent, and then I add these silver equivalent ounces to the real silver ounces, and then I have the total number per year.
That's how you get the cost.
Exactly.
Yeah. No, it makes sense. That makes sense. We said there's like the 7.6 million silver, the 76,000 gold. I mean, what is the reserves? Like for how many years can they keep pumping this out?
Yes. The mine plan they published end of 2024 had a 13-year mine life. However, they've already published a resource update in summer this year, yeah, and that resource update added 36% of resources. Yeah, so they have actually already more in the ground that they have published in the old technical study, and they're still adding. Yeah, so the CEO recently said in an interview if they would have the same throughput like in the technical study they published end of 2024, they would have more than 20-year mine life with the resources they already have identified. Yeah.
Wow, that's
Yeah.
almost double.
Yeah.
So, okay, cool. So I don't know. Have you looked at all at the history of this company? I mean, I understand they bought this mine. They bought this in 2016. This not the mine, but the project.
Yeah, the deposit. Yeah.
So I don't know if you have any comments on the history.
Yeah, I mean, what is common in the mining industry that these deposits have been known typically for decades already. So that means you have many previous operators that have done exploration. They have done like soil sampling. They have done something that's called geophysics, geophysical methods to see where could be gold or silver. They have done some drilling, and it's no different here. The deposit has already been known for, I think, at least 30 years. And they have some old data from previous explorers, yeah, like some old drill data, etc. And what happens is often these explorers, they just run out of money at some point in time, yeah, because if they don't find enough fast enough, they can't refinance. And then, or maybe there's a bear market in gold and silver, and then they just can't get money to do more drilling and more exploration. They run out of money, and then they close down. Yeah, and then they typically just sell the deposit to somebody else and the exploration license, including the data. Yeah, the data gets often transferred, and this is basically how it happened here. Yeah, so there were several explorers previously around. They didn't find enough, and then they moved it on to the next one, and then in the end it was Abra. I think that you're right, they bought it in 2016, but they actually really started the exploration effectively to a large degree started in 2019, yeah, where they really ramped it up because they got some financing that allowed them to do exploration, and yeah, they've since then pretty consistently done roughly 20,000 meters of drilling per year since 2020. Yeah.
So, what about management? What do you think of management? I think I read that the CEO has been around in the industry for like 18 years.
He has been around quite a bit. He worked for, let me see, I have a slide here. He actually worked also for Lundin Mining. Lundin Mining is a pretty famous company in terms of, because it's controlled by the Lundin family, and they have a very good track record in mining. Built several mining companies very successfully. He also worked for Barrick, and he worked for a financial institution called BMO, which is active in the mining space. But his background, interestingly, is more on the finance side. So he's not a geologist. Yeah, so he's more on the finance and corporate finance side. But he has been for a very long time, more than 20 years, he says now, in the mining industry. So he knows that very well. And then they have also in the management team a geologist that has more than 40 years of experience in South America. And they also have, importantly, somebody who is very experienced in project development. Yeah, so they have a guy called Jeremy Weiland. He is Senior Vice President Projects and Development. He has more than 20 years of experience building mines in these areas in South America. and he also worked for Lundin Mining and Kinross Gold last. Yeah, and I think that is also a very notable thing, because one of the challenges of these exploration companies is often they are very good at exploration, but they're not really experienced in building mines. So that is often then a skill problem for these companies to make a transition from exploration to then actually developing a mine. And then either they say, okay, we don't want to build it ourselves, so they try to get acquired by a company that has experience building mines, or they get the company in-house by hiring people with the relevant experience. And that is the case here. Yeah, so the guy from Kinross, I think he joined the company almost 2 years ago. And Kinross, by the way, is also a shareholder in Abra, so they have like 4% of the shares.
Yeah, I was actually listening to a YouTube video yesterday, and CEO was on, and he said that amongst the insiders being Central Puerto,
Yes.
Kinross, Eric Sprott, and management, they control about 25%
Yeah.
of the company. So Central Puerto, that's, any comment on that?
Yeah, that's a very unusual shareholder, because it's a utility company in Argentina, I think a pretty big one. And they are actually private, yeah. So it's a private utility company. They're listed, yeah. They have shares. They have part of their generation and net is in Salta province, yeah. So they are actually they also have quite a lot of mining companies as customers already, yeah. And they are actually considering extending the electricity grid towards the south to the place where the mining or where the deposit is of Abra. Yeah, so that's actually one potential benefit, could be that the electric grid gets extended, and then they can get power and electricity from the grid, instead of basically having diesel generators and solar panels running, which is much more expensive. The background is basically yes, it's unusual. On the other hand, I felt like it's an interesting aspect, because they are local and they are a potential supplier of electricity to Abra in the future.
Is that how they get to their $13 cost? Is because, is there a certain advantage of that area or their relationships which lowers their cost of production?
The $13 is actually not even including a potential grid connection. Yeah, so the $13 is with diesel generators and solar. The main reason, or there are several reasons why they have this low cost. Probably the very big driver is grade. Yeah, so how high is the concentration of gold and silver in their deposit? Yeah, the higher the grade, the lower the cost. For a simple reason, if let's say you have 300 grams per ton silver, yeah, versus 100 grams per ton. If you only have 100 grams per ton, you need to move 3 times the amount of material and push it through the processing plant compared to the 300 gram per ton. Yeah, so that means you need 3 times the mining equipment, you need 3 times the plant size, and you need to move much more material, yeah, which is also costly in terms of OPEX. Yeah, and that's probably the biggest driver. Other drivers are the way you do the mining. The mine Abra Silver is planning is an open pit mine, because the deposit is close to the surface, so you don't need to dig underground, you don't need to build tunnels, etc., which is much more complex and requires more capex. It is relatively straightforward. Yeah, so you basically, to make it very simple, you dig a hole. Okay, you have some waste on top. You dig away, you throw away the waste. Also a little bit simplified, yeah, and then you dig out the ore, and you put it into the processing plant, and out comes gold and silver. That's basically what they do.
I mean, this $13, because I have no idea what costs are like. What are the other miners
Yeah,
are? Is that low? Is it high? Where is it?
it's on the low side. So I have seen many miners that have between $15 to $20 per ounce is much more common. Some even have more than $20 per ounce.
So I guess would the lower cost then producers also have like a premium multiple of valuation in the market?
Yes, it has 2 effects. One is obviously your margin is higher. Yeah, so that means you have much higher gross margin. Yeah. It also means that you you should have a higher multiple because your mine is lower risk. Yeah. To give you an example, if you have a mine that has, let's say, to make a crazy example, $30 an ounce production cost, yeah, and if the silver price drops, you are much more at risk of getting into trouble than if you have, very low cost, then you can survive it.
Yeah. Well, the other thing I noticed on that call is like the guy said, they've also just added another board member, I think, that used to be an
yes, she was at Lundin. She was the CEO of Lundin Mining.
So he was
she has
he was
excellent
very
connections.
excited.
Yeah.
He was.
I mean, she is. You're right. She's also on the board of Vale. She wasn't in the management, but she's on the board of Vale, right? But she was actually the CEO of Lundin Mining previously, also. So she is extremely well known in the industry. She has unbelievable amounts of connections, and I believe, if you want to finance a deposit, you probably can't have a better person as a board member than her. Yeah, because she has unbelievable connections and enormous background in the whole financing areas as well. Yeah, which she did for Lundin. So.
Cool. Yeah, because he was very excited about that. And he said, he's got like a dream team. And it seems to me, because at the end of the day, whether this is mining or whether this is, tech or something, because they're pre-revenue essentially, let's say, you have to have a lot of faith that, the management is going to deliver. They have the experience. And so, having the right people there really improves your probability.
Yeah, absolutely.
On Argentina, though, we have these new incentives, we have this tax. Is there a risk, though, that maybe the next president or whatever, next parliament comes out and says, scrap all this, this is illegal, blah, 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 blah. They're like stealing from the government and the people. And so we need to reverse back all of this stuff.
Yeah, you always have political risk. And I still believe political risk is the highest risk for the company. Even after Milei and his party won the elections in late October. However, the good thing is they now have enough seats in parliament that they will be in power for another 2 years. Yeah, so I think the next presidential elections and parliamentary elections are in October 2027. And that means by then, the company has already finished the technical studies and has already done the financing and is already in the process of building the mine. Yeah, so that means, sure, that somebody else could come in and drip up all the agreements, etc. But that is then no longer affecting mine financing, let's say it this way. Yeah, so that's a little bit less risk. Yeah, but so basically you have a 2-year runway. But I agree, it is a risk. And of course, if the economic reforms don't convince the voters by 2027 to say, yes, this is working, I feel my economic situation has improved and I want to vote again for the parties that have done this change, then of course it's a problem. Yeah, so it's definitely a risk.
Okay. So going back for us non-mining investors, just to get a better feel. So we know our production costs. Now, from what I understand, from a cash flow perspective, those production costs are usually include like maintenance capex, but does not include capex for new mines.
Yes.
So we have that margin, whatever, 13 minus, I don't know, let's make it easy, 63. Let's make it 63.
Yeah.
So we got like $50 margin, right? So then we need to take out financing expense. So you have to make some assumption about how much debt they're going to raise. So I don't know if it's, let's say, 300 million.
Yeah.
I don't know, what kind of financing do you think these guys are going to get? Like, is it going to be like 15% or something? Or
yeah. It's quite interesting. Quite a lot of mining companies I looked at in the development stage have financing costs of typically 13-14%. Yeah, this is quite common. And then, of course, they have all kinds of restrictions in terms of the asset is the collateral. Yeah, so if they default on the loan, the asset goes to the financing corporation. And they have milestone payments. Yeah, so it's not that they get all the money in the beginning. They have to fulfill certain milestone requirements to get then several tranches of the financing. And they have amortization schedules. Yeah, so typically they have to start paying back the financing maybe latest a year after the mine is in production. Yeah, and then quite common they have to pay like on a quarterly basis to not just pay interest but also amortize the loan. Yeah, and then most often it's like 5 years or so. Yeah, that they have to pay back the whole amount, including interest, within 5 years. But the way I calculate is normally when I look at valuations of companies and how they could finance mines, is I say, okay, I think they could take on debt that is as high as 1 year of free cash flow. That is basically my rule where I say this is a very safe way of financing, because this allows them, even if the price goes a bit lower, they still have enough, breathing space with a 5-year loan to pay it back, even with a little bit lower metals prices.
Okay. I mean, with 13-14% secured, I think I'd be more interested in buying some of the debt than the equity.
That's not publicly traded, unfortunately. So I've never seen, honestly, I'm not familiar of any mine financing that would be a public instrument. Yeah, that's normally done by very specialized companies. Yeah, that like Orion Mine Finance is one in the US, quite famous, that does a lot of deals off Franco-Nevada. Yeah, for instance, did the mine finance deal with G Mining. And they also got like 13% interest for a $75 million loan, in addition to the stream.
Yeah.
So.
Well, then there's also the alternative. I remember back when I was working at the emerging markets hedge fund. I mean, I think we even bought like Province of Salta USD bonds. So I think, I don't know if you've looked at alternatives. I think you remember that in Cyprus, one of the guys presented
Abra
Province of
I think was the name.
Yeah, that was that was like Colombia, Brazil, but he also presented Province of Buenos Aires. So I noticed I even owned personally in the past some bonds at like 15% yield that did really well in Argentina. I don't know if you considered that at all.
And to be honest, I haven't looked into that one. Yeah, because it's a totally different type of asset, obviously. Yeah, so it's a fixed income, and so you basically have to do a lot of macro analysis, I believe, and also political analysis. While for the mining companies, the macro of the country locally is actually not that relevant. Yeah, as long as politics doesn't go bad, it doesn't matter if the economy in Argentina is growing or shrinking. I will be okay. Yeah, as long as the voters don't become too unhappy.
Okay, so and then I know they got some tax incentives. What's the tax rate then for these guys?
Yeah, so that they will have, if approved, they will have a tax rate of 25%, corporate tax rate, and that is down from 35%, which is now the regular corporate tax rate.
Okay, cool. So what are you assuming for because essentially, at the end of the day, it's a project. You could treat this like NPV, here's what it's going to cost. We said 544 million. We're going to get, 13 years at minimum, let's say, if we're going to be conservative.
Yeah.
And then the bullish scenario would be 20 years. We've got, we know the financing, we said 13-14%. We even know depreciation. We can just depreciate that, whatever this capex over, I guess, 13 years, I guess. And so we know how much it's going to go out in taxes, roughly, ballpark at least. So what do you calculate this as, net present value of this?
So basically, when I take these $544 million capex and a little bit of money for working capital, that they also need.
Yeah.
So I basically said $570 million, assuming $270 million in debt with, what did I calculate? 12% interest rate in that case, and $300 million for a stream financing, and then I get the net present value of roughly 2.6 billion, bit more than 2.6 billion US dollars at the current gold and silver prices. And the current market cap is, let me see, it's roughly if I update it. So it's the current market cap is about 1.2 billion. Yeah. So it's basically undervalued a little bit more than a factor of 2 if I calculate the net present value to 1st of July 2028. Yeah. And I forgot to mention, also important, the discount rate I'm using is 13%. Yeah, for all the free cash flows.
Why 13? Just curious.
Why 13? Because 13, it's often the rate of, how shall I say?
Financing rate?
The financing is quite common in that range. And it's also something that if you have an exploration company or a developed that has not yet cash flow, I think you should have a little bit a higher rate of discount, let's say, compared to G mining, yeah, or compared to other companies that have already regular cash flow. That's why I take 13% typically for companies that are not yet in production.
Okay. Well, I mean, you put that discount, you discounted that to, I'm guessing 28, but so you should discount that another 3 years then
Yeah, if you want to
to bring it
discount it
back
to
to
today,
today.
yeah, sure. Then you basically get 1 second. Yeah, you basically get like 50-60% upside, something like that. I don't have it right now here.
Yeah, no, it's still,
But
I mean, if I got this
and I mean,
right,
it's what
yeah,
is important. This is just
yeah,
including the mine plan that they have published in 2024. Yeah, and we already know they have more gold and silver on the ground, and we know they will have an updated mine plan in spring next year with the final study. Yeah, so if you would include this one, basically additional resources from already gold and silver that they already found, plus what they're going to find until next spring, plus what they may find in the future, yeah, then the upside is, of course, significantly higher. So in that case, if I say, okay, they continue having exploration success, then the fair value would be, or the net present value would be more above $5 billion, yeah, like $5.2 billion, so roughly double of the initial mine plan with 13-year mine life.
Okay, so the 2.6 was only 13 million.
Yeah, 13 years, yeah.
Now that makes a lot of sense. And this the 2024 that which study or plan which you're basing the numbers off of. Is that on their website?
Yeah, that's published. You have to find it. They have somewhere probably technical studies or so. There are different ways to find it. Either you go to the company website. Let me see. Or I have it. I read it, but I'm not sure what the fastest way is. Either the company website or there's something called SEDAR, which is the Canadian basically stock exchange file service. Yeah, and there you also have all the technical studies. You can go, if you go to the company website and then you go to projects, yeah, under projects, and then you go to Diablilos, and then there you have technical reports. And if you click on technical reports, you will find basically, okay, that's the latest technical report, and then with the resource update, and then you can also go and click on the pre-feasibility study from December 2024, and then you see the summary, and you will have for sure the full file for download available somewhere. But in that, you can always go to CEDAR, enter the company name, and then search for the study. Yeah, that always works.
Yeah, there is the 544 million with a further 77 million in sustaining capital over the life of mine.
Yeah. And the 77 is included in the all-in sustaining cost. Yeah. So this one.
It's in our $13.
That's why it's exactly. Just initial capex is not included in the all-in sustaining.
Yeah. Okay. And they're coming out. They came out with an NPV of 1.3 billion, which is where the market cap is, but it's based on significantly lower silver prices, because I see here on the website it's like $25 silver price.
Yes, it's $25 silver and $2,000 gold. Yeah, so you basically have more than double now.
Yeah. Oh, this is great. This is great.
They do have significant leverage, to the gold and silver price. So you have not, so if gold or silver, if it goes up like 50% or if it doubles, the NPV more than doubles, because of the leverage effect. And that's the other thing why I like it, because of course you have to be careful with assumptions. So I always take basically the spot price and then I look at the sensitivity if the price goes up or down. How the valuation changes, how net present value changes. But if you are in a precious metals bull market and precious metals prices go up, then it's even more. So I did the calculation, including the additional resources that they've already found, or that they find in future with exploration that I would expect. Then I would actually get at $4,300 gold and $63 silver, I get basically a net fair value per share, net present value per share of roughly 40 Canadian dollars, which is about 4 times upside by 2028. And that is good, no complaints about it. But actually, I mean, if I wait for 3 years and the share price is then at 40 Canadian dollars, I would actually think something has gone wrong, because in a precious metals bull market, precious metals go higher. So if silver and gold go higher, then the net present value goes up even more. And if it gets even more crazy because silver miners are extremely rare, the prices literally explode. So it's very common actually that in the late stage of a precious metals bull market, that these companies trade above net present value, especially the silver miners, because they're so rare. I don't want to give a number, but I would say it can be then significantly more than 40 Canadian dollars in case the bull market continues. So, and maybe one number just to give you an idea. Because the question is, of course, okay, fine, the gold-silver ratio roughly is currently roughly at 66. And the historic average since 19 gold is floating basically freely is 61. So it's still slightly above. But in a bull market, that ratio typically goes below 50. And I mean, as an example, just the bull market in 2011, it went to 32. So if we get another one like in 2011, that would mean that the silver price could double while the gold price stays where it is. And so you see, I think there's still quite a lot of upside here. But it's not something I would use as a base case. I would just say, fine, it has to work with the current prices, and then also check a little bit, upside and downside sensitivity if you change, or if I change the prices for gold and silver in the net present value calculation. One thing I forgot to mention is that because these silver miners are so rare, I think could also be that the company gets acquired sometimes next year. Because after they got the environmental permit, after they got the investment incentive approved, and after they published the last technical study, there's basically almost no more risk in terms of permits or anything like this. And the technical details because the technical study has been done. And that could very well be the time when, for instance, Kinross, which is already a 4% shareholder, knows the company extremely well because they're on the board, and they have one guy who joined now for the project. Kinross might just say, okay, guys, here's an offer, 100% premium, I'm buying it. And then I would actually expect to see also some competition. I mean, unless they make a crazy premium that nobody else is interested. But if the premium is not really high, I would expect other companies to come in, like First Majestic Silver or some other silver producer, and say, hey, we want to have a silver mine as well, so we're offering more, and then they could actually go into a bidding war, which is always a nice thing to have if you're a shareholder. So, that's definitely one option, but it's not, I should say, the investment case doesn't depend on it. It would be nice, but they can also just build a mine and produce silver and gold.
I see on the website, what's this La Coipita?
La
Sounds like
Coipita.
something you eat for breakfast or something.
You may have stomach troubles afterwards.
Well, it has the pita part, right? It has the pita.
Yes, it has the pita. Well, it's actually a second project that I haven't yet mentioned. So that's basically a free option. Because what they have is they also have an exploration property in another province, San Juan province. And that exploration property has potentially copper on it, maybe in significant quantities, we don't know. So what they did is, a couple of years ago, they said, okay, their focus is on the gold and silver deposit in Salta, the current project. But they still have this second exploration license, and they don't really have the money and the resources to do anything with it. So they did an option agreement with Teck. Teck is a big mining company, also has quite a bit of copper mining. And the way it works is that Teck is basically paying for all the exploration expenses and is paying a little bit of money, not that much, a few million dollars over 5 years to Abra Silver. And if Teck is then successful and finds enough copper, in the end, Teck will own 80% of the property and the project, and Abra will own 20%. Yeah, that's basically how it works. If Teck decides to exercise the option after 5 years of exploration, and this is basically just a free option. Yeah, if they find copper, and the province is an area where they do have very large copper mines. It's not completely crazy to believe that they could have really a copper deposit in that area, and it's a pretty large. I think it's like a 700 square kilometer area, so it's not that small. And you have other companies in that area like BHP and Lundin Mining who are currently in the process of building very large copper mines in the same province. Yeah. So it's basically another option. But I didn't even include it in any NPV calculation because you don't have any data and because it's extremely uncertain. Yeah. So you don't know much. The Teck has drilled a few holes, and I think they have published 3 holes or so, and they found some copper and other stuff. And I'm like, yeah, interesting, but not enough to say anything. Yeah. So you have no idea if they will in the end find enough copper to actually build a mine. Yeah. Not to know.
Okay, man. I love free options.
Yeah, me too.
So wait, this trades, like we said, this trades in Canada.
Yes.
It's I'm just pulling it up here. How liquid is this? It's okay. Does about 500,000 shares at $10. That's about 6 million. I see here about $6 million worth on average then a day.
Yeah, right. And in addition, they do have a market maker. Yeah, so if you want to buy, bigger volumes, then if you offer a little bit above the ask price, you get pretty quickly filled. So I mean, by now, I think liquidity, unless you're a really big institution, by now liquidity should not be the big problem. Yeah. Of course, it depends also. I mean, if it's between Christmas and New Year, probably not a good idea to try to buy something there because liquidity is just too small. Yeah, but if it's a normal trading day, it should be okay.
Yeah, I think most people are gonna shut down in 2 days. So
yes, they should.
And so I hope they manage to listen to this podcast in time. But Samir, this has been fantastic. I really enjoyed it. Enjoyed this conversation. Is there anything we haven't included? Because I think we've served this idea in a silver platter to the listeners. They can just
Yes.
They don't have to do it at 3 times speed. They can do it at 1 time speed and actually write down the numbers and go to the website. And I'll put a link to the website so that people can click on it and then read the feasibility study or whatever.
Yeah. I maybe 2 things I would highlight. One is the catalysts, which I think are quite numerous over the next year, and then also the risk I would still like to mention. Yeah, so the catalysts are basically, okay, I mentioned we are in a precious metals bull market, and it looks like we're also in a silver bull market by now. Yeah, and this just means if you get capital inflows into silver miners, the capital inflows are typically, the market cap of all silver miners together is very, very small, even compared to gold miners. Yeah, so that means if you just get any capital inflow, these stocks go up a lot. That makes them so attractive. So that's one catalyst. I think it's also a catalyst that Argentina has become more attractive as an investment destination, especially after the elections in late October, where initially there was some concern if Milei may lose some seats or not, but he actually did better than expected in these elections, so that risk is at least until 2027 probably gone. And you have the feasibility study that will be completed in the first half of next year. You will have the environmental permit probably in the first quarter of next year. And the likely approval of the investment and tax incentives also in the first quarter next year. So you have a lot of catalysts. And then, as I mentioned, you basically just have a situation whereby probably sometimes in the second quarter of next year, the company would be ready to be either acquired, potentially, or to do the mine financing and then start construction. And that is normally also a good point in time to just hold it, because then people see, okay, it's now construction has begun, and this could be a mine within 3 years, roughly, after construction start. And last but not least, the risks. As I said, I think there's still, of course, political risk long term. So we don't know what the elections will bring in 2027 in October. Obviously, you have also commodity price risk of gold and silver, in case you have a complete meltdown in the stock market. And then you may have a situation like in 2008 where even precious metals dropped quite a bit. That, of course, would significantly hit the mining companies, no doubt about that. And then you have the usual risk for miners. Like, okay, you have cost inflation to build the mines. You may have a delay in the mine development, and in the start of commercial production. And of course, last but not least, it's still a company with just one asset, basically. So if you have, let's say, a natural disaster or something like that, it could close the mine. So you definitely should, if you decide to invest, you should size it accordingly. So don't bet the house here. It's an interesting investment, but you should really not take crazy risks here.
Yeah. One, is it typical for there to be delays? Is one question. Is there a chance it's not late 29 and it's late 2030? That's one. And two, is it typical or not to have a cost overrun? So instead of live 44, it costs, a lot more.
Yeah. Let me first deal with the cost overrun. What is very common is that as you conclude the technical studies and as you update the technical studies, that your costs increase. That happens to the best companies. So that would not surprise me when they publish the feasibility study in spring next year, that it's not 544 million, but it's maybe 600 million or maybe even 700 million. Part of it is also just mining cost inflation. That has been a general trend in the industry. That is something the company has not much control over. In terms of cost overruns, when the project has started, that does happen. That is actually quite common. But because the mine is so profitable, the case would still work. So they could have, even a capex overrun of, let's say, 50%, which would be very significant, and it would still be a short payback period of for sure less than 2 years. Probably 1 year or so. Even with a 50% capex overrun, that doesn't have that much of impact. And if they have a delay at that point in time, when they have all the permits and everything, there are still delays possible, but I would expect the delays are typically not much more than maybe 6 to 9 months. And it's actually that's probably generic. The type of the type of mine they build, because as I mentioned, it's not that complex. It's not like an underground mine with huge complexity. And the main thing is really they don't need to wait for government approvals or permits. But by the time they have the environmental permit, etc., it's basically just an execution thing. Normally, this is something that can be done in reasonable time frames, without huge delay risk. So the worst I could imagine is that they have, maybe a capex overrun of, let's say, 30%. That would be already very significant. And the reason why I mention it, say it's significant, is because quite a bit of capex is the equipment. And the equipment they normally order very early. So very early on in the first year of the project, normally they do most of the equipment order. And they also have these the contractors that they do the contracts with, and the contractor cannot just come back and say, hey, sorry, I now need much more money. That doesn't work like this. That's why I say more than 20-30%, I think, is very unlikely. And in terms of time delays, if they have all the permits, they don't need to wait for the government. I think it's maybe 6 months, but I don't think it's more. And the companies I invested in so far have been basically on time. Like G Mining has been on time with its mine, Erdene has been on time with its mine. That's it's normally not a huge risk. And it's not, maybe one more thing. I mean, it's very different if you would look at the large copper mines, these are much more complex and much bigger. Yeah, there you have sometimes, mine build timeframes of like 6 years. And then, of course, a lot of things can happen in 6 years, but the gold mines and silver mines, they typically get built in 2 to 3 years. So not that much can change that could delay the project.
Okay. All right. This is fantastic. I mean, I would say if anyone is listening and they want to reach out to you, how will they contact you? LinkedIn, Twitter?
The best mail is to send me an email. Yeah.
Okay.
And or they can also contact me via LinkedIn. Both works. The only thing, if they contact me via LinkedIn, they should mention the podcast or something, yeah, because otherwise I might think that they're just somebody who wants to sell something, yeah, like some financial advice or whatever. And then I normally don't respond to contact requests. I have no indication why they contact me, yeah, other than potentially selling something.
Yes, I'll put the link to Samir's LinkedIn in the notes, so feel free to send him a message unless you're selling something.
Exactly. One more thing I would like to mention. If somebody who is listening to the podcast happens to be in Asia, yeah, or happens to be either living in Bangkok or occasionally traveling through Bangkok, then I'm on a regular basis organizing dinners with other value investors in Bangkok. And if people are interested, they can just contact me, and then we'll touch base and see if he can or she can join.
Yeah, I mean, for sure. It's like Samir said, he's in Bangkok. He organizes these dinners at the Indian restaurant.
Yes, that's one of them.
That's the lucky restaurant. That's where they.
It is.
If it's discussed at the golden table, then the investment will go up. Isn't that how it's been? That's the historical.
That joke.
The historical performance of the golden table at the Indian restaurant in Bangkok. I love those mango lassies. Isn't it mango lassi that you called it?
Yeah.
Those were so good. Those were so good.
Yeah.
Those that fruity drink or whatever, and it didn't even have alcohol in it.
No, it didn't.
Thank you for this, and I'll see you soon in Vietnam.
Right.
All right.
Okay.
Take care then.
Right. Yeah. Bye. Softglass. Bye.
The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and/or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.